Guys, welcome to our channels. Today we learn some basic concept of accounting. What is accounting? Accounting is an art of recording, classifying, summarizing, analyzing and interpreting financial transaction. It helps to know profit or loss and the financial position of a business. R. N. Antony given a definition of accounting. An accounting system is a means of collecting, summarizing, analyzing, and reporting in monetary terms information about the business. R. Lewis and Lon Gillespie given a definition of accounting. Accounting may be seen as a consisting of recording, classification, preservation, and interpretation of financial information. Accounting as a science and art. Accounting is both a science and art. As a science, it is based on systematic principles and rules. As an art, it requires skills and experience to apply those principles in real business situations. Hence, accounting is rightly called both a science and an art. Objective of accounting. What is the objective of accounting? This is the main objectives of accounting: to maintain systematic and accurate record of financial transactions, to classify and summarize business transactions properly, to find out profit or loss at the end of each accounting period, to show the financial position of the business through the balance sheet, to provide necessary financial information for decision making, to determine the correct amount of tax payable to the government. Now we learned function of accounting. What is the function of accounting? These are the main function of accounting: to keep complete and systematic record of all business transactions, to find out profit or loss by preparing the profit and loss account, to prepare the balance sheet showing the financial position of the business, to provide necessary financial information to concerned parties, to communicate business results to owners, government and other stakeholders. Now we learned limitation of accounting. What is the limitation of accounting? Accounting does not show non-financial things like employees' skills or company reputation. It can be based because different methods like depreciation or stock valuation give different results. It records assets at old prices, so it does not show real value when price change. Accountants or managers can change figure to make the report look better. This is called window dressing. It may not always show the true profit or real financial condition of the business. It records only money related transactions and ignores other important factors. Use of accounting information and its users. There is two types of use. First we learned what is the use. Accounting information helps in recording, summarizing and reporting business transactions. It is used to make information decision, plan for the future, control operation and reduce business uncertainty. Now, user. Accounting information is used by two main groups: internal user, owners, to know profit or loss and financial position; management, to plan, control and compare performance employee to check company performance and job security, external user, investor to decide whether to buy or sell share, banks and creditors to check financial strength and ability to repay loans, consumers to know product cost and supplier stability, government for taxation and regulation, regulation, public and analyzed for research and general information. Basic terminology of accounting. Business transaction. Any financial activity record in the books account. Record of transaction related to one item. Capital. Money or assets invested by the owner in the business. Drawing. Money or goods taken by the owners for personal use. Liabilities. Liabilities. Amount the business owes to the owner. Assets. Things owned by a business that have money value. Receipts. Money received from selling goods, service or assets. Revenue. Income earned from business activities. Expenses. Costs spent to run the business. Cost. Amount spent to make or buy something. Income. Revenue minus expenses. Profit. Extra amount left when income is more than cost. Gain. Profit from non-regular activities like selling a fixed assets. Loss. When expenses are more than income. Purchases. Good bought for resale or production. Sales. Goods sold by a business. Stock. Goods kept for sale or for making other goods. Debtor. Person who owes money to the business. Bills receivable. Retain promise from a debtor to pay a fixed debt. Creditors. People to whom the business owes money. Bills payable. Written promise to pay money on the fixed debt. Goods. Item bought or sold in the business. Voucher. Proof or evidence of a transaction. Discount. Reduction in the selling price. Books of account. Journals and ledger where transactions are recorded. Entry. Recording of a transaction in the books. Balance sheet. A statement showing assets, liabilities and capital on a given date. Income statement. Report showing income, expenses and profit or loss for period. Cash flow statement. A statement showing cash received and spent during a period. Conclusion. Accounting is not just about number. It is the language of a business. It helps to know profit or loss and financial health. Subscribe my channel for more easy lesson on business and accounting. And next video we learn journal entry, ledger and other things. So keep watching my video.